this morning. We have Erik Ogard of Russell Investments, where he helps oversee $150 billion worth of assets. Erik joins us from Seattle. Erik, your take right now on, again, another big sell-off on Wall Street.
Yeah, I think the primary takeaway at this point in time is that we have a fear-based, emotional-based market right now. Certainly there are real economic things to be worried about. However, it's the degree of reaction that we think might just be a little bit overdone at this point. We're dealing with a slowing economy for sure. We're dealing with debt-related issues in Europe and a slow policy response for sure. But at the end of the day, our view is we are going to avoid recession in the U.S. economy, albeit with slower growth, and the market right now seems to be pricing recession. So that sets up for a nice rally in the fall, we think.
Well, what makes you so sure that the U.S. will avoid recession? You know, we heard from Morgan Stanley, their predictions really, I guess, tipping the markets into the sell-off, saying that the U.S. can easily fall back into recession. And you just got the Philly Fed manufacturing numbers shrinking by the most since 2009. There are some scary numbers out there pointing to a big slowdown, if not recession, negative growth in the U.S.
Well, potentially, but again, you know, we go on the facts that we see today. And the other thing we go on is that we have an extremely vigilant Fed, and our Fed policy, as opposed to Europe's, has been well in front of the curve here. So if we should see the 10-year yield linger, say, below 2.25, 2.25, I think the Fed will become hyper vigilant once again, and we should not rule out a QE3 if that should be the case.
Okay, you should not rule out a QE3. Okay, so let me ask you this then. How long do you think this selling, this panic, volatility will last on the markets?
Well, we think it will resemble past volatility events where you get very spiky behavior in VIX. And to a degree, you can think of VIX as registering something like a seismic event in the world of earthquakes. And so what happens is you get reverberations after the fact, and sometimes for many weeks. And so we think, just like we had in the events of 2008 and 9, you have a spiking VIX environment followed by lower highs as things moderate over the course of 3 to 4 months. Our expectation is we see a more moderate VIX, say in the mid-20s by late October, early November, and a market that's advancing well off of these lows.
Erik, let me just bring up what we heard from Barton Biggs. You know, he's been called the ultimate big picture man. He says to the extent that the markets are really weak and it's scaring the hell out of people, and that's affecting investment, also the economy in the future. What do you think it's going to take to change sentiment right now?
Well, it may take more than just language from the Fed, and unfortunately with respect to interest rate policy, pure interest rate policy, they seem to be out of powder. So it's either going to be rhetoric or action in the form of, as I mentioned earlier, a QE3 event. But that will have to be seen based upon the actual weakness we may get out of the economy.
What's the likelihood, put a probability to the extent that we might get a QE3 package?
Well, we put the probability of recession at about 25%. So we're 75% in the camp that we're going to avoid recession. But should we get information that suggests the probability is going up and say beyond 50%, where it seems quite certain, I think you're going to see the Fed take bold action at that point. But we really think we're going to avoid recession. It is true that the stock market has a virtuous feedback loop component to it. And if the stock market's up, it can become an engine of growth and an engine of psychological strength, leading to consumer spending and business spending and all sorts of good things. And when the stock market's down, that can have a dampening effect. So, you know, the Fed is watching the market for sure, and if we spend too much time down here in a weak market condition, expect some action.
Okay, well, you know, it looks like Russell Investments being pretty brave here, because you're saying that this sell-off really represents a buying opportunity. Buying into what?
Well, we believe, just as evidenced by the VIX, that the cost of defensiveness, the cost of buying insurance, is really what the VIX represents. The cost of doing anything defensively, whether it be gold or whether it be Treasury securities, is what we think of as highly priced. And yet the price of being a little bit more aggressive, you know, you can find some very good deals on growth opportunities in the markets. And our focus has been and continues to be to find very reasonably priced but robust growth and to go with that. In particular, we like the emerging markets as an engine of growth for the next, 5, 10, 20 years even.
Yeah, and taking a look at your sector selection, I have to say very brave, because you're looking at these cyclicals. I mean, yeah, selective financials are part of it, since a lot of investors have been dumping financial stocks because of what's happening in Europe, and also questions about the U.S. recovery, but also consumer discretionary names and technology. And you're saying maybe it's time to take a little bit more risk in these markets. That's pretty surprising to me.
Well, you have a choice, and when just take this show, for example, and multiply it by all the other business shows out there that cover the economy and the stock market, and take the mainstream media. What's everybody talking about? The negativity in Europe, the negativity in the United States, the sell-off in equities and other risky assets globally. I think this stuff is pretty much fully priced, and so the question is, what side of the trade you want to be on? I think you're either in gold, you're in cash, or you're buying some risk here, and we just think it is way too late to be a seller, and you have to be a buyer, much like you did in the dark hours of early 2009, late 2008.
Yeah, what are you trying to say, Eric, that we don't say anything new here on our program? Is that what you're accusing us of?
Hopefully it's not being taken that way, just that everybody's focused on a few big macro events, and that's getting reflected in security prices. And unfortunately, the individual investor, the people that are least equipped with the information and the perspective to ascertain what might really be going on, get scared, as the quote from your guest said. They get the hell scared out of them, and that means they sell. And history shows that if you're selling with a wave of sellers, it's probably not the best idea.
I won't take it personally, Eric. I'd like to see you again on the program. Good to see you. Erik Ogard of Russell Investments joining us from Seattle.